We are live on Facebook.
Good evening, everyone. We welcome you all to OrthoTV in association with MFA, my financial advisor. They are truly my financial advisors. And the topics here which we select are after deep discussion between me and the MFA team. So today's topic is very interesting. It's about insurance. Can insurance policies ensure your financial security and retirement? And we are going to talk on real life case studies and why insurance is not an investment. And we have with us Ms. Chanda Verma. She is the Vice President and the Financial Coach at MFA. She has been dedicatedly working with doctor fraternity for the last 7 years and has an in-depth understanding of their life and financial needs. She is the integral part of a doctor practice team which has met more than 10,000 doctors and a strong believer in a goal-based investment. Working closely with doctors on a day-to-day basis, Chanda understands the finer nuances of the doctor's financial life and is an expert in helping them making smart and informed financial decisions. Over the last 15 years, she's worked with leading organizations like GE Money and HSBC Bank with exposure to various sectors like credit underwriting, training and audit in financial services products. She's highly qualified. She's certified by the National Institute of Securities Market as an investment advisor, and she's a postgraduate in marketing from Sydenham College. We also have with us Ms. Sneha Kalsekar. She is an assistant vice president and head of the planning and research team at MFA with a specialization in insurance. She is associated with MFA since the last 12 years. She has done her postgraduate in insurance and finance. With this, I would stop my screen share and I would hand over to Ms. Chanda Verma to take over the proceedings.
Thanks so much. Good evening. Neeraj, should we wait for a few minutes before we start? Let the people join in. You're on mute.
We are already live on OrthoTV. You can start.
Okay, great. So good evening. It's always a pleasure to be on this platform, talk to you all, and obviously contribute to this awareness sessions that we have on OrthoTV. And whatever we can do a bit to help you improve your financial decisions, we are glad to do that. So today our topic is on insurance. Can insurance policies help you secure your life, your retirement, and your goals? Now, before I delve into it, let me just share my screen. Just a second. Is it visible? So I want to just talk a little bit about MFA. Neeraj has already introduced me, but let me introduce my company. We are the only firm who has been helping doctors over the last 17 years, making prudent, informed decisions with regards to their personal finance. Now, I personally have met over 3,000 doctors and I handle more than 300 doctors as our clients. We have a special newsletter called RS Insights for our doctors on various topics related to finance that can help them in their day-to-day financial decisions. It all started with this book, really. There's a book, Financial Planning for Doctors. It's been written by our founder, Mr. Amar Pandit, published by CNBC TV 18. And this has spread financial literacy among the doctor community. It has sold more than 75,000 copies. Also, our depth in the doctor fraternity is very clear from the various associations we've had. We are the financial literacy partners with Indian Orthopaedic Association. We've done various conferences and spoken at various conferences on various topics, whether it is conferences with the orthopedics, with the cardiology team, with the urologists, with the pediatrics people. We have had talks at Sion Hospital, Apollo Hospital, and also at the Fellow Gynecology Society of India. So let's just jump directly into our topic for the day, which is on insurance policies. Now, there are a plethora of policies which are available in the market, right? They have so many fancy names: pension plan, money back plan, whole life plan, wealth maximizer, children's plan, Jeevan Saral, Jeevan Anand. And there are so many of these that you can really get confused. And I'm yet to meet a doctor who doesn't have some or most of these policies, and not just one, multiple policies. And 80% of the doctors I have met in my experience are very satisfied and happy that they've done this investment. Now, I want to just lay the foundation here why this topic is important. Because when we think that why do we take these insurance policies, there are so many options available. What is the thought really at the back of our mind when we are thinking of investing in these policies? And after speaking to so many doctors and even other people besides doctors, I realized that basically what we are thinking is at my old age, I should have some corpus which comes to me little bit for my security. Or my child is going to grow, he's going to go to college, he's going to get married. थोड़ा पैसा मेरे को आना चाहिए थोड़े 10-15 साल के बाद मेरे बच्चे के लिए. So the whole idea, the base emotion behind actually buying these policies is nothing but some kind of financial security, some kind of financial stability. And therefore, when we are investing in these policies, what are we thinking? We are thinking, acha, after a particular term, after the maturity of the policy, what am I going to get? What some amount of corpus, some maturity amount should come to me, which will give me a little bit peace of mind, which will make me a little financially secure. Now, this emotion is very, very valid. It's very, very important. And the insurance companies know this brilliantly. And the way they market insurance policies is amazing. Look at all these ads. Sir utha ke jiyo, zindagi ke saath bhi, zindagi ke baad bhi, guarantees, ensure your life, etc., etc. Now, all these words which you see, they give us a lot of comfort because they are appealing to our underlying emotion, the emotion of taking care of our parents, taking care of our old age, taking care of our children, basically our security that we are looking at. And then we love the presentations done, the charts shown, the tables shown, the calculations shown, and we invest in these policies. But as a layman, none of us, and I've met so many doctors and so many other people, none of us have the tool or are able to actually analyze, do these policies that I'm investing in actually give me the financial security I'm looking for, what I'm investing for? Now, what we have done is in our course of experience, we have analyzed more than 10,000 policies of different companies. Sneha and her team itself have worked on all these policies, and we see a common thread somewhere after going through so many policies, seeing how they work, how they eventually pan out. What we've done is we have picked up some popular policies. These are real life case studies. We have actually worked on this over the last many years for our clients and given them guidance how they should deal with these policies. Should they continue? Should they change? How should they achieve this financial security in a better fashion? So let me share, there are 4 case studies that I'm going to share one by one. Let me share them with you. So let's go to the first one. Now, this is a traditional life insurance. So you would see many policies which say this is a saving plan with profit, without profit, endowment policy. There are the taglines they use, which is guaranteed income. You will have money back. You will have money back for your children, etc., etc. So I'm clubbing all these kind of policies together, giving you an example. So this was one of the policies by the topmost and a well-known public sector organization like an LIC. So one of the policies that they had was, there was a sum insured of 35 lakhs of our client, for which he was just paying an annually a premium of 3 lakh rupees. This was only to be paid for 10 years and the policy would mature in 11 years. So this was a policy which somewhere we had analyzed in 2019, some 2.5 years back, 3 years back. The tagline of this policy, when I asked my client, why did you do this? He said, life has no guarantees and I was getting assured benefits. So let us see what the promises were made with this policy, what the agent told them. First, pay premium for 10 years and you will get assured benefits for the rest of your life. A guaranteed income of 3 lakhs every year for next 25 years or 99 years of age, whatever you decide to choose. After 10 years of paying premium, you will start getting 3 lakh rupees, the premium amount that you've paid every year coming back to you. Besides that, whatever premium you've paid for 10 years, all that entire 30 lakhs will also be paid back to you. So there is a tax benefit as well, besides getting all this money. And there's also a death benefit. If anything happens to you, then whatever is the sum assured, whatever may be the additions, loyalty bonuses, etc., everything will be paid to you. When I, as a layman, look at these promises, the agent is talking, just pay 10 years, you'll get guaranteed income, you'll get your money back, you have tax benefit. What's not to like? You love this policy, you'll buy this policy, you'll invest in this policy. Now let's look at whether the family was really financially secured if they stayed invested in this policy. So when we break it down, what happens is the client is thinking, I'm paying for 10 years, I'm paying 3 lakh rupees, I'm just paying 30 lakh rupees. What am I getting after that? For 25 years, next 25 years, I'm going to get 3 lakh every year. So 75 lakh मेरे को आ जाएगा over my 25 years of life. All my premiums paid, which is 30 lakh, will also come back after 25 years. So totally मेरे को तो 1 crore मिल रहा है. मैं 30 lakh pay कर रहा हूँ, मेरे को तो 1 crore मिल रहा है. Now let's break it down. You're getting this 1 crore, not now. You're getting this 1 crore after 35 years. You're getting the 3 lakh every year for 25 years. You're not getting a lump sum in your hand. You're getting 3 lakh a year. You divide it with 12 months. You're getting 25,000 a month. After 10 years, 25,000 a month ka value kya hai? 70,000 rupees. So when you'll actually need the money, that 25,000 rupees a month or the 3 lakh rupees a year is not going to suffice any need for you. For nothing, not for fees, not for retirement, for nothing. And when we actually calculate the percentage return you've got for 35 years, it's only 6.8% return every year for 35 years. That is not even the inflation in our country. You leave the money in fixed deposit, maybe you would have earned a little more if you've kept it for 35 years and put a lot of amount in it. But this was not getting you anything. Is the family therefore secure? You go with it thinking you're secure, but are you really secure? No. Now let's look at a situation where you had said, okay, for 10 years, I will invest rupees 3 lakh, not in an insurance policy, in some other investment product. It could be stocks, it could be shares, it could be something else, a combination of products. The possibility, and if you pay this 3 lakh rupees, put it in an investment for 10 years and let that money just grow for next 25 years. You would have generated a corpus of almost 9 crores, 8.9 crores. This is the power of compounding. And that truly is the difference, and that truly is the security. So instead of looking at an insurance policy to get 3 lakh rupees per year, which absolutely has no value after 10 years, you might as well look at alternative options to create a major corpus for you, which will actually give you the peace of mind. Now, there is another type of policy which is quite similar, but these kind of policies say we cover you for your whole life, right? So that example of this is we had a case where we look at a sum assured of 20 lakhs. Also, please note that look at the sum assured, 20 lakh, 30 lakh, 50 lakh, 75 lakh. It's not a huge amount. It is a very small amount, and look at the premiums you pay for it. The annual premium in this case is about 69,000-70,000 a year. So, and in this case, the premium had to be paid for 30 years because it's a whole life policy. You pay premium for a longer tenure. So you pay a premium for 30 years, but the policy will mature only after 40 years. So after you've done paying premium, you wait for 10 years and the maturity is after 40 years. This was a policy somewhere around 2012 that we had analyzed. Now, the good part in this was the client was told कि तुम पैसा तो pay करोगे, but तुम्हें bonus भी मिलेगा, assured bonus, हर 1,000 रुपए पे 70 rupees मिलेगा. So what is the client thinking? Wow, I'm paying 20 lakh over 30 years, 69,000 into 30. What am I getting back? I'm getting back this 20 lakh. I'm getting a guaranteed bonus of more than what I've paid. I'm getting 57, 58 lakhs as guaranteed bonus. So total, I'm going to get 4 times of what I'm paying. I'm going to get 78 lakhs. Maybe the money of 78 lakhs, he probably doesn't have the clarity. But he knows the agent is telling him 4 टका आपने जो पे किया है उसका 4 गुना आपको मिल जाएगा. You're happy because you don't sit and analyze these. You don't know how to break down these numbers. But when we break down the numbers, we realize that after 40 years on maturity of this policy, when you get 78 lakhs, you've only got 4.75% return. Again, think 78 lakhs ka worth after 40 years kya hai? Nothing. But all we think is 40 साल के बाद एक 78 lakh हाथ में तो आएगा. You see the maturity amount. That's all you're seeing. You're not seeing whether this 78 lakhs potentially could have been 7 crores that you could have got. You're only looking at that 78 lakhs as a lump sum amount. The returns are only 4%. So what we did for this client actually went and surrendered his policy. He had paid for only 4 years. He surrendered his policy. He had a temporary loss. The premium that he had paid, he could not have recovered it back. So he had a temporary loss. But he started investing that premium amount for next 30 years. He decided, I don't want insurance policy. I will put this amount somewhere else. I will invest it in a proper investment product. And this money for him can potentially grow. For the same time period, he would have continued the policy. Instead of 78 lakhs, he would have got 3 crores. Now you tell me, 3 crores or 78 lakhs? By doing the right thing, what gives more security to your family, to yourself? Financial security. Obviously 3 crores. Right? This is how the policies are designed. Now, this is another policy very, very widely sold, ULIP policies. Now, ULIP policies are unique. They are not like the other traditional policies. Let me explain you with an example. This particular person had taken this policy almost for 1 crore 40 lakhs. It looks like a good amount of covers, 8 crore 40 lakh. The premium that he was paying is 20 lakh per year. This he had to pay only for 15 years. The policy would mature in 15 years. This was a policy of 2018 that we had checked out. Now, in ULIP policy, what happens is it's a unit-linked policy. So basically, it means it invests in equity or in debt mutual funds. It invests in mutual funds through the route of insurance. So insurance cover bhi hai aur market mein mutual funds mein invest bhi karta hai. Now, this particular option that the person had taken, now in a ULIP, you have different options. You can invest in different types of mutual funds. You have to select. Not the investor understands what type of funds he should select, but with the help of insurance agents, he makes a selection. Now, this particular client had invested 100% in equity funds. Now, when you dig deeper in the details of the policy, look at this. These are charges. In ULIP policies, most ULIP policies, except a few which they have started now marketing because they realize that people are realizing this big drawback, is that there are a lot of allocation charges in ULIP policies. Look at it. Year 1, 5%. मतलब आप 20 lakh pay करोगे, उसमें से 5%, मतलब 1 lakh charges में चला जाता है. Only 19 lakh is the amount that actually gets invested. Same in year 2, same in year 3, same in year 4. In year 5 becomes 4%. Year 6 onwards, this charges go away. But at the same time, there are other charges. There is policy administration charge. There's a fund management charge. There are mortality charges, which is calculated. No one knows beforehand how much really it will be for the next 20, 25 years. So there are different charges. So when we actually sat down and broke these charges down, we realized that 4 to 5% matlab 1 lakh to cut gaya. 1 lakh over 15 years. Imagine it is close to, and even if you don't pay six years onwards, over the 15 years, what you're paying, you're definitely your 5 lakh, 6 lakh, with the fund management charges, your 7, 8 lakhs are definitely gone away in charges only, just for this one ULIP policy. So the amount that gets invested is very low. This affects the returns from this policy. We actually did a small analysis for this person. This person had just paid 1 premium when he had come to us. So we analyzed this for him. We checked that what was the value of this 20 lakh that he had paid. After 4 years, the value of that 20 lakh was 25 lakh. How did we find the value? It's a fund value. It is invested in mutual funds. It was a fund value. You can find the fund value. It was 25 lakhs. So the actual returns was only 5%. Now, if he had not invested in mutual funds through a ULIP policy and invested directly in similar mutual funds as was invested through this policy, his 20 lakhs, and this we had checked as per that day's value, his 20 lakhs would have been 32 lakhs. The policy, the mutual funds that he had invested in, the similar kind of funds, the value of those funds, if he had directly invested, was 32 lakhs. That was a return of 12%. This difference is primarily because of the charges that he pays, Also, the mutual funds that you invest in, there's not really enough transparency. You don't really know who's the fund manager. You don't really see on a day-to-day basis what the fund is doing. You don't get news about it. You just know most of the clients and most of you who would have invested in ULIP. If I ask you, "Acha, kya value aapke mutual fund ka?" You will not know. But if you had mutual funds and I tell you, do you know what is the value of your mutual fund? You can quickly go online and find it out. That is the transparency I'm talking about. So the important point to remember is, one, in ULIP policies, annual charges are very high, but you can't see them because they are in the terms and conditions somewhere. You just look at the premium amount. You just look at what you'll be getting out of it. This gets deducted from your premium. Also, you are locked in for 5 years. Whether or not you pay the premium, you're locked in for 5 years. You have to stay invested for 5 years. After 5 years, you're free to move your money. So the policy holder, besides that, like I told you, there's not enough transparency in terms of which exactly funds are your money is being invested in. How are they performing? Can I see the performance? Can I talk to the fund manager? Can I know what is going on? Transparency is limited. And typically, any action that you will take in a ULIP policy, like we did for our client, is you have to wait for 5 years. Till after 5 years, you can withdraw your money and rather put it directly in mutual funds than going it through the ULIP route. The good part is that most of the policies, the way they are designed, the ULIP policies, there is limited tax or no tax on the withdrawal of this amount. Yeah, so this is very, very, very important. These policies are widely sold, they are missold, so you have to be extremely careful. These are the pointers we are giving you just for you to know and understand. This PPT will be shared, so you will have this at your disposal. And another important policy which gets widely marketed are the pension plans. Now, pension plans can be ULIP, they can be traditional, they're designed again in different ways by different companies, giving different fancy names to them. But basically, you have to understand what a pension plan works on. Pension plan obviously means you're going to get some pension. That means you're going to put in money, and at some point in time, you're never going to get the whole money back. You're only going to get some money in tranches every month or every quarter or every year. So this was again, look at the amount, right? So the annual premium was 5 lakh rupees. The person had to pay this for 10 years. He had to pay the premium for 10 years. So maturity was in 10 years. मतलब 10 साल 5 लाख दो और आपका pension चालू हो जाएगा. So how is this policy sold? Pay premium only for 10 years. उसके बाद आपको लाइफ लॉन्ग पेंशन मिलेगा 3.5 लाख का हर साल. Sounds very attractive. You will also have an option that the pension can go to your spouse in case of the death of the person who has taken this pension plan. Plus, there is a tax benefit on the vesting. When you vesting the policy means when you start taking the money out. So this is how a pension policy is typically marketed. Now, the important thing to note, particularly in policies like this, they are tax inefficient. Although they say there is tax benefit, they are tax inefficient, and therefore the returns are very low post-tax. Why is that? Because in a pension policy, you don't get the full amount back. So for example, in this example, this person has paid how much? He's paid 5 lakh rupees for 10 years. So he's basically paid 50 lakh. Now that 50 lakh has been invested, it will grow. Maybe it will become 60, 70, whatever amount it becomes based on the mutual funds they are invested in. Because this was a ULIP pension plan. But at the time of vesting, when you decide to take the money back, only 1/3 of that amount you get back, which is tax-free. That is the tax efficiency you get. But 2/3 of the sum, that is converted into pension, whether it is annual, whether it is quarterly, whether it's monthly. And this pension comes to you after cutting tax. So these are taxable pension amounts. So the tax efficiency goes away. Now the pension amount of 3.4 lakhs. Again, if you look at it, 1 saal ka 3.4 lakhs. Again, 25,000 a month. How does it provide you any pension? What will you buy with 25,000? Yes, you will have other things to do, but 25,000 just goes away like that. It's in some expense. It doesn't take care of your financial security. Now, the pension amounts are low because our annuity rates are low. Our annuity rates are only 6.5% in the current scenario. This is the rate you will continuously get till the time you live or till the time you die. For many, many years of your life, only 6%, whether it's 10 years, 15 years, 20 years. That means after 20 years, when you receive a 3.4 lakh pension per year, it will be a negligible amount as the year passes, as inflation goes up. Mehengai to बढ़ती जा रही है. So this pension amount is not adjusted for inflation. It remains 3.4 lakhs. What would be the value be of 3.4 lakhs after 10 years? So if you want to have pension which comes to you, which can help you to a large extent, at the same time, it takes into account inflation, that you know that आज 3 लाख चाहिए, but कल 3 लाख 10 चाहिए पड़ेगा, फिर 3 लाख 50 चाहिए पड़ेगा, फिर 4 लाख चाहिए पड़ेगा. Then you have to invest in pure investment products. You can't invest in pension plans, because these kind of plans will never give you returns which will help you to adjust for inflation over a long period of time. So these are the 4 types of insurance plans which are very, very popular, using different names. They are marketed, and these are typically the policies that we have seen people buy. All doctors would have these policies. Now, does that mean, so basically in conclusion, what we see that irrespective, only 1 or 2 policies maybe here and there might have been extremely good, but otherwise most of the traditional policies, one, they don't give you enough cover. But because what do you look at a cover? You take a 20 lakh, 5 lakh, 10 lakh, 50 lakh. You take 4 or 5 of these policies which combine together, but they are small amounts. They don't go more than 1 CR probably, or 1.5 CR cover. So they do not give you enough cover. A single policy you don't take policies which are of huge amount. They don't give you enough cover because the premiums are very high. For a 10 lakh, you might be paying a 1 lakh premium. So the premiums are very high comparing relative to the cover they offer. Again, like I showed you in all these examples, none of these give you good returns which can beat inflation over 10 to 20 year period. Maybe ULIPs can still give you because they invest a particular amount in market irrespective of their charges. But traditional policies will never give you returns. The maximum 5 to 6%. That is the trend we have seen over the last 10, 15 years. So does that mean when it comes to insurance policies, and we are talking whether insurance is going to give us a security we are looking for, can it secure my pension, my retirement, can it secure my goals? Is there no policy out there which is right for me? That's not true. There are sensible policies which are available, which are just right for you. But before we delve into that, what is very important for us to understand is, why should you take life insurance? See, I've shown you so many examples. If you see all these examples, what have the people done? They have just said, okay, I want some money after 10 years, after 15 years. I want this money for some financial security. I want some corpus which comes to me. So the thought always is कि मैं इन्वेस्टमेंट कर रहा हूँ, मेरे को थोड़े टाइम के बाद पैसा मिलेगा, और हाँ चलो लाइफ भी कवर हो जाएगा, अगर मेरे को कुछ हो गया तो फैमिली को कुछ तो पैसा मिलेगा. But the very term insurance means to ensure, and life insurance means you have to ensure that your family is protected in case of loss of life. So the focus is on loss of life and not on investment. I want a corpus, I will survive 20 years. I will get a corpus at the end of 20 years. No, the focus is on, if I don't survive, is my family secure? That is what life insurance is for, which people don't understand. People just don't think, and there is not enough literacy on this. So understand, when you take life insurance, you have to take it only for 2 reasons, not for investment purpose. You have to take it for 2 reasons. You have to sit back and think, do I have a family who needs to be taken care of in case something happens to me? And when I say need to be taken care of, they will have expenses to take care of. They will have to have their daily expenses. They would have to have expenses for their goals. It could be education, it could be learning, it could be marriage, it could be anything, buying a car, paying off a loan, etc., etc. What are their goals? What's their future need? All these things have to be taken care of, not just 30 lakh, 40 lakh, 50 lakh. Second important thing, if you are going to take a loan or you already have a loan, any loan, business loan, clinic loan, equipment loan, housing loan, you need to ensure that. Because if anything happens to you and you're no more, someone has to pay off that loan or that thing gets taken away. It may be a personal loan also. right? So it's very important that only if there are these two conditions, you have to take a life insurance policy. Otherwise, life insurance policy is not to be taken, not for any investment purpose, not for any children, not for any pension, nothing. Because for all that, there are other products available. Life insurance means you just need to take term insurance. You can take one term insurance policy, 2, 3, whatever it is, but you have to take only term insurance policies. Let me explain a term insurance policy in a very simple language. We all have cars. We all drive cars. We all have a car insurance. We insure our car. Our life is even more valuable than car. But let me give you this example. We all have cars. Now, if we drive the car and if there is any problem, accident, etc., we claim it, we get our insurance. If there is no claim to be made during the year, do you go back to the insurance agency and say, okay, I didn't claim this year, please give me back my insurance money, my premium amount. I have to keep accumulating it. Only when I have an accident, I will claim it. Otherwise, I cannot, right? In a car insurance. That is exactly how term insurance works. There is nothing to receive after 10 years, after 15 years, nothing. Term insurance cover continues. You pay a premium till the time you live, till the time you want to pay the premium. You can decide 55, 60, 65 years of age. The moment you don't pay the premium, the policy stops. In case anything happens to you and you're no more, the entire purpose goes to your family. Now, why this works is because there are no frills attached. There's no money back. There's no charges, no payment to be done. The term life cover comes for a huge amount for a very small premium. It's a no frills policy, like a no frills airline, right? It is more reasonably priced. So you may have a term insurance. So for example, by paying 5 lakh rupees, you may have a term insurance of 20 crores, 15 crores. You can get a term life insurance of a huge amount for a very small amount. For all other policies, what are we paying? We are paying 5 lakh, but what are we getting? Only 50 lakh, 60 lakh, 70 lakh, 1 crore. Here you have a huge amount for very less. Let me give you an example. Again, a real life example taken. At an age 45, now this is all based, you know that, insurance is basis our age. So if you are at an age of 45 and you take a 1 crore cover for say 20 years till your age 60, 65, you pay a 5 to 6 lakh as premium as per any traditional policy. In a term life, if you take a similar term life for the same age, for the same duration of 1 cover, look at the difference, just 35 to 40,000 per annum. That is the difference in the premium. And that is why we say it is higher cover for a lower premium. It's huge. It's a vanilla cover. You do not look at returns. You do not look at maturity amount when you're looking at life insurance or a term cover. That is the reason you should take life insurance. I want to explain this term insurance with a real life case study. This was a family of doctors. They had their own hospital. They had a total cover in insurance policies of about 3 crores. They had many policies. They had 37 different policies. If I look, one policy for 5 lakh, one for 10 lakh, one for 7 lakhs, one for 40 lakh. If I add up all, it was coming to 3 crores. And the premium that they were paying for different policies was 26 lakhs per year. Now, when I asked them, why did this happen? They said that hey, some patient comes, they want to pay back. They said, sir, please, ye policy le lo, I will take care of this. We buy it from an agent. We have to maintain good relation with our bankers. They come and tell us to take a policy just to keep the relation. वो सब होते होते last 10-15 साल में हो गया. So you have 37 different policies. Now we sat down and we analyzed. Now, why do we do this is also very important. See, in financial planning, risk or insurance is a very, very important step. We don't even talk about investments. We don't even talk about what you need, where to invest, stocks karo, ye mutual fund acha hai, falana. We don't even talk about that till we have not analyzed their insurance policies, till we have not analyzed their insurance need and first taken care of this risk cover. We can't go ahead. So what we did for this person, first we checked what was their life situation. We realized that they had a business loan for their hospital. They had taken almost 10 crores and 10 years were left for the loan to be over. Besides that, the family had 2 young kids. One was in Australia, one was here. They were young kids. They were learning. They just gotten married. They were looking to settle in their careers. So the family said they need at least 5 crores to take care of the family in case anything happened to the doctor. And we realized when we analyzed those 37 policies, just like all the analysis I just showed you, we analyzed all their policies, and each and every policy we found what's a plus, what's the minus, what's a hit, what's a miss. And we realized most of the policies neither were giving them a good cover, neither was it a good investment. None of them were giving him good returns. Mostly the returns were in the range of 5 to 6% per annum. And also these policies were taken from so many different people. In case they needed to claim it also, where would they go? The insurance agent keeps changing. They don't even have the numbers. No one picks up the phone. There's a family friend. He's left that company. Bankers left the bank. Who do you go to? It was a nightmare operationally. How did we help them? Because they are also looking finally at financial security, right? So how did we help them achieve the security? More importantly, they had a life cover of 3 crores. They had 37 policies. After analyzing all these policies, we said, hold on. First of all, your need for life cover is not 3 crore, but 15, because you have a 10 crore loan to pay plus 5 crore need for your family. You need 15 crores. This 15 crore we gave them by 3 different policies of 5 crore each. Now, the idea being there's flexibility. You can stop one policy if you need. As your loan keeps reducing, the loan reduces, you can stop one policy, let's say 5 crores, right? So this is how we planned it. So instead of 15 crores, instead of 3 crores over 37, he had 15 crores over just 3 policies. Then what we did is we helped them to get out of either surrender or make paid up or continue some of the policies, but surrender a lot of policies. The premium amount they were paying, if you remember, I told you was 26 lakhs for a 3 crore cover. He was paying now only a premium of 3 lakh 85, less than 4 lakh for a 15 crore cover. That's the difference. That's the term covers benefit. So for a very high cover, a very low premium. So he was actually saving 21 lakhs per year, 2 lakhs a month. That can help him in so many different ways. That can help in compounding. He can invest this money. He can use it for his expenses, whatever. But the saving, a rupee saved is rupee earned. He saved 21 lakhs per annum. And from 37 policies, we brought him down to 6 policies, along with the security he needed. So less tension, more peace of mind, all the security he needed, less of operational hassle. All of this was achieved by doing this analysis. So what are the key takeaways? I've analyzed so many policies. I've talked about term cover. I've talked about a case study on a term cover and how it has helped families. The key takeaways from this webinar is, when you think of insurance, don't think of an amount, a maturity amount, a pension amount. Think that what is the amount I need because of loss of life? That is the security I'm looking at. The financial security you're looking for an amount, for a maturity amount, a pension amount, a bonus amount, that you can get from other investment products. Insurance is not the answer for it. Ask only for term life insurance. Different words are used. Like I said, wealth benefit, profits, bonuses, assured benefits. Cut the crap. Talk about only term life insurance. Also, people usually don't know what is the insurance amount they should take, which is why we see policies of 10 lakh, 5 lakh, 1 lakh. You know this is not going to help you, but you don't know what to do. You just think, well, this is an amount I can pay as a premium. This is an amount which is okay. I'll receive this amount. Theek hai, chalega. You don't have a figure in your head because we've not been trained to, we've not learned it. Just a thumb rule. Take an insurance amount which is at least 10 times your income. That much amount your family will need if the breadwinner is no more. And if you have a loan, over and above this, you should cover that loan also, just like I showed you in the case study just now. Always register your policy under MWP Act. This is a very important act. It basically allows Your family, when they receive the money on your death, they can decide what they want to do with the money. If there is an obligation, the creditor can't come and say, I want this money, first you have to pay me off. Very important to register it under this Property Act. And more importantly, do not think insurance is an investment. Like I said, it's first, if you're no more, what happens to the family? You have to cover that. And by the way, it is an investment for life. It is not an investment to give you a financial security, a financial amount at the end of 10 years, 15 years, or 20 years. It's that for that you have something else. It is not insurance. So do not buy pension, annuity, endowment, money back, whole life, unit link policy. I'm saying this again and again because this is very important for it to register in our brain, because the charts we see, the talks that we hear, there are so many examples given with 4% return, 8% return, 10% return in those charts. We get confused. We say, okay, this will give me something now. Let me take this policy. Do not fall into that trap. These are the key important takeaways from today's webinar. And now we are open to question and answer session. I hope this has helped most of you who are listening here.
Yes. So there are, first, I have many questions, but let's take the delegate's question. Dr. Ashok Shah is here. He has asked two important questions. What are the average charges deducted in ULIP policy after 5 years besides mortality charges? Will it be more than regular mutual fund charges?
Sneha, do you want to answer that?
Yeah. So basically, sir, after 5 years, currently the way ULIPs have been, competing with mutual funds, we are seeing that, they are coming in par in terms of charges for as compared to mutual funds. So post 5 years, mainly the charge that gets deducted is the fund management cost, which is also there in terms of the expense ratio for mutual funds. Also, since these ULIPs also provide, your life insurance cover, they will have a deduction of your mortality charge. So yes, post 5 years, there are no charges, but the first 5 years where there are charges, which is the main important charge is your premium allocation charge, which is, approximately 5% of the premiums that you have been paying. And these are the monies which are invested in a ULIP, which is there for the longest period of time in the investment. So the charges that you pay in the start actually brings down your returns. This is like an entry load that you would be paying,
His next question is...
Just to add, most of the policies will still have these charges. There are very few policies right now which are available where they try to remove these charges. But as latest as 2020, 2019, we've still seen charges that are close to 5% for the first 5 years. And that, like she said, is going to bring it down.
So can I say that a regular mutual fund will have approximately 1% charge on an average, 1 to 1.25% maximum? And on an average, if you count the period of those 10 years, and if you count these first years of 5%, it will have almost double. If you count the policy, it will have almost double plus the mortality charge, which is extra.
Yeah. So basically, I would say the 5% which is calculated is on the premiums that you pay. So when I compare 5% to your fund values, over a period of time, I would say that the charges would be in totality along with the fund management cost and everything around the 3 to 4% compared to 1.5% in mutual fund in terms of the expense ratio.
Okay.
Also, Dr. Neeraj, we have to understand that in mutual funds, your units don't get deducted because of that charge. Right now, in insurance policy, you get your lesser amount gets invested. Here, जो तुमने invest किया है वही तुम्हारा, जो तुमने डाला है mutual fund में वही तुम्हारा रहता है. So whatever returns you get I've already taken into account that fund management charge, which doesn't happen in insurance policy.
So what I would like to highlight here is what Chanda is indicating is in a ULIP policy, your investment return is not equivalent to your investor return. Okay. Yeah. Today, when it comes to mutual funds, today you say you have invested 1 lakh rupee in mutual funds. You invested at 100 rupees, cost price, you know, you have received 1,000 units. Now these 1,000 units, whenever you want to know what is my current value, you can just look at the NAV of that particular mutual fund, and you will know that this is the current value of my investments. What happens in ULIPs is that today the fund value which gets displayed is a fund value of the fund in which you are invested. But after the fund value is declared, there is always the fund management cost and your mortality charge and your other charges get deducted by deducting the units from the fund value. So at any point of time, you will not know that these are the number of units that I have, that I can do a simple multiplication math and figure out this is the value of my investments as of today.
Let me just ask you one more extension of this question.
Yes.
So the ULIP policy has almost the same risk as my portfolio of mutual funds. Am I right?
It has the same risk, but today in terms of mutual funds, today when you're investing in mutual funds, the idea is to create a diversified portfolio across categories, and this is how MFA has been doing for our clientele. Today, when you invest in ULIP, see, ULIP will give you, firstly, you say that you want to pay a certain amount of premium, say a 5 lakh rupee. Now, this 5 lakh rupee, an agent will just guide you that these are the funds that I have, you know, a maximizer fund, a balance fund, a multiplier fund, a conservative fund, you know, these are the names. Now, where do they invest? What amount? What is the amount that gets invested in large cap, mid cap, etc.? Or how does this money get invested is something that, you know, most of my clients that I've seen, I have not even chosen these funds. You know, this fund is taken by the agent. So today you don't know. I had seen an example of a person who had invested in ULIPs. Okay, but because she was a conservative investor, the agent picked the conservative fund for her. She remained invested for around 5 years in ULIPs, and 80% of her investments was in liquid fund, because the conservative
Which gives her only 3% return.
Which gave her no returns, basically. So to say she was in a ULIP product, but because the agents just take the conservative fund as considering her risk appetite, her study of the risk appetite that person must be having, she was invested not in the markets even for a period of 5 years.
So basically, Neeraj,
full extent,
you are comparing wrong products. It's not an apple to apple comparison.
No, what I'm asking is basically a very simple question. It can be either yes or no. It became a little longer answer, I understand, because you wanted to give details.
Yeah.
Where if a mutual fund is an equity mutual fund, and my ULIP is also like say maybe most of it is in equity. Okay. Yes. Similar way, the diversification is almost similar of my mutual funds and ULIP. Do the risk in both are equal or no?
Yes, it is. Because your underlying is
your underlying is the same, the risk is equal, but the risk also is a risk of cost, and the risk of cost in the ULIP is more.
Yes. So of course it is more, that we all understood, but whether the risk is the same, or people should understand that the ULIP policy is an equal risk as mutual fund, because
as long as you are investing in same kind of
similar type of portfolio.
Yes. Yes.
Now, Dr. Ashok Shah is asking, after 5 years, is it still worth coming out of ULIP as there are tax benefits?
There are tax benefits in the ULIPs prior to the, this financial year. I think the last financial year has started where the ULIPs only with a premium of less than 2,50,000 rupees is where you will get the tax benefits. Any ULIP above the premiums of 2,50,000 rupees will be taxed as per the equity long term, which is 10%.
So, what will you recommend for him? He's now paid ULIP for 5 years or more.
Yes.
Should he come out and go directly in mutual funds, or go through like a financial planner company like yours and go into mutual funds, or should he continue in ULIPs because he's now first 5 years are gone because the charges to lag gaya hai.
Charges lag gaya hai, but then
abhi to in fact charge nahi lagna
analysis karna padega basically in terms of the company also. What is the mortality? What is it that today? Which kind of a fund he's invested in? I mean, it's a very broad question. I can only answer it after studying the product.
Okay. So Dr. Ashok Shah, so this see, that is what is very good and honest about MFA is that they will not just tell you कि नहीं आप निकल जाओ हमारे पास आ जाओ. Any other financial company would have said or agent would have said, नहीं नहीं आप ULIP छोड़ो आप हमारे साथ आओ. So see, they are not selling insurance policy, they are not selling ULIP, but they are also not giving you wrong guidance. If they feel that your ULIP policy maybe is right, they may not tell you to come out of it. But at the same time, if you compare ULIP and mutual funds, mutual fund definitely is better. The risk is almost the same if the diversification is almost the same. So now there are some questions which I have noted down during your presentation. Let me just open those. So I have already, there is one policy which I have for almost 9 years. It's a very small premium. That's why I keep on paying. It is only a few thousands. I have already paid premium for a Jeevan Saral policy for 9 years. What should I do?
Dr. Neeraj, I would just say that firstly, Jeevan Saral is the most unsaral policy that I've ever seen. Okay. I really wonder whether it's a small premium or a big premium. How this policy was marketed, the marketing genius has been able to sell these policies, because the first feature of this policy says that you keep paying for 10 years in this policy. And only after 10 years is something that we will start giving, we will make you participate in the profits of the organization by giving you loyalty additions. Now, when we have compared any traditional policy in terms of where the revisionary bonus are given year on year, we have seen that the returns are in the range of 6 to 7% over a period of 20-25 years. I mean, this has been the range of the returns for the traditional endowment assurance policies. Okay, now when for the first 10 years you are just paying the money and this money is not making any money, I wonder how that gives a relief to people that to invest in such a product. But nonetheless, if you've invested and if you're in the 9th year, probably you can wait for 1 year, see what is the bonus that loyalty additions that get accumulated, and then take a call to exit from this policy. In general, I would never say to exit a traditional policy, because whenever you want to surrender a traditional policy, there is a very high surrender charge. Surrender charges are, nearly, you only get 30% of the premiums paid, excluding the first year premium, plus a little bit of the present value of the bonus that have got accrued is generally what gets paid. So, you face huge losses in terms of the cash flows. But in Jeevan Saral, the kind of surrender values that they have around 90 to 100% of the maturity sum assured. There are two sum assureds in Jeevan Saral, if you will know. There is a sum assured, which is a death sum assured, and there is a maturity sum assured in Jeevan Saral. So based on that, they have around, they have this kind of a 90 to 100% where you get the monies back, which is equivalent to the monies that you have paid. So there is no, the loss is the opportunity loss, but there is no loss in money terms. So depending on, so let's complete for 1 more year and then check the loyalty additions, and then you can take a call to surrender the policy.
So let me reframe the question, because I am at 9 years. Somebody may be at 4 years, 5 years. They should exit
immediately.
Okay.
Immediately.
Oh, very good. So now, now I'm planning to take a home loan. Okay, I'm planning to buy a home and I have to take some amount, maybe 20 to 30% for the home loan. Rest I'm going to pay. So one of my friends who has taken a huge loan, some banks are now pushing insurance policy, then they're including them as a extra part of the EMI only. I mean, supposing my EMI is, say for example, 25,000.
Yeah.
And so they're pushing that you take insurance and you pay the EMI, say 26,500 or 27,000. It's a very minimal amount, which is, but actually it is 10% of the EMI extra.
Yeah.
And if I already have a term plan worth 2 to 3 crores, which is the more than the value of the flat or more than the value of the loan, should I still be taking a home loan insurance or no?
You should not. So whenever a banker is pushing you to buy an insurance along with the home loans, you should tell them that we are interested only in the term cover and not in any investment linked insurance, whether it's a traditional policy or a ULIP.
No, it is a term cover only they are providing. They are basically covering only the loan amount. So for example, my loan is 1 crore. So they are only covering that 1 crore, but they are adding that amount in my EMI in spite of me having a term plan. Okay. And I have heard that some banks are now making it compulsory.
So yes, firstly, if they make it compulsory, or they will give you a leeway in terms of not taking a term plan if you already have a huge term cover. The idea is when you're thinking of, what is the amount which is good enough for me as a term cover, you have to do the analysis whether this amount is enough. So today, Dr. Neeraj, for you, if you think that this 2 to 3 crores is necessary for your family in terms of, see, today what is insurance, as Chanda has explained, is just a security. Okay, it's a security that when you are alive, when you are there, you will definitely accomplish the family goals, and you will take care of your spouse's income need, as long as you are there, since you are the main earning member of the family. Now, in case you are not there, all these things goes for a toss, correct? So if you think today that the 2 to 3 crore cover that you have is just sufficient for these goals, like taking care of my children's need in terms of the education, marriage, etc., taking care of my spouse's future needs, is this amount is definitely required for them. But now I have an additional liability of, of 1.8, or the amount that you mentioned, then yes, for the additional liability, you should take the additional term cover. But you think that you've already taken a term cover which is much, much higher than, your needs of the family, and it definitely covers the liability that you are adding on to your family, then there is no need for it. So yeah.
The only advantage which I feel where it is technically, or I should say logistically, a little easy, is that if you have a term plan attached to your loan, then the EMI is gone, and house remains with you.
Yeah.
If in case something wrong, bad happens to you.
Yeah, exactly.
So that is one, logistically speaking, a little easier to solve. That is the only reason I think which basically we should be taking the term.
And all the bankers also think that way. Because whenever they are giving a loan, it's not that they want to take away the house from the family. They've given the loan after doing the credit analysis of your finances. So they also want to cover the risk of only you not being there to service the EMI. Yeah. So yes.
And what about this? Dr. Ashok Shah said, nowadays, see, I am seeing that MFA is full of young girls and like you, they are dynamic people who are basically making a good living. Sometimes the husbands are taking either a backseat or they are earning less than their spouses. Does the MWP Act is applicable to them? I'm sure it's not, because it's a women's act, I think.
Yeah.
Am I right?
Yes, it's not.
Yeah, it's not applicable. It is. There are households. I have also seen there are households that basically where the woman is making more than, and sometimes the husband is taking a back seat. It's happening nowadays, especially in a city like Bombay. It's happening more than that. We are noticing it.
Correct.
But it's definitely, or both are earning almost equal.
Correct. Yeah. So MWP Act is more to protect your spouse, like especially females, the wives who are completely homemakers, and I think this apparently was more effective in the previous generation than, our generation now. But yes, still, when we know that, we have still seen, Chanda, correct me if I'm wrong, where in terms of finances, we have taken a lot of initiative in helping women today, to empower themselves with the financial terms. It's not only about them earning, but it's also to empower them. They leave a lot of these kind of decisions to their husbands, but we want women to also take joint call in all the family decisions which are related to finances. So yes.
Okay, and I also want to ask in the reverse way then. See, supposing my wife is not making any active income right now. She has a lot of passive income.
Yes.
But if she's not making any active income, do I need to take term plan for her?
Not really.
Sneha, let me answer that.
Yes.
So Neeraj, like I said, the first two things you have to think of when you're taking a term cover or life insurance. First is, do you have dependents? So if you don't earn and you're no more, will they be out on the streets, right? Or will it be difficult for them? So maybe I am 25 years old, I'm not married, my family is not dependent on my income, I will not take a term cover. The moment I get married, I will take a term cover. So if your income, people are dependent on your income, you have to take a term cover. If people are not dependent on your income, you don't need to take a term cover.
So that's I think that's it for all the questions for now. So one thing which I want to tell all our doctors is that insurance is not an investment, it is an expense. Consider it as an expense. Your mediclaim is an expense. Your term plan is an expense. Your car insurance is an expense. Hope and pray to God you never have to use it. And you basically live a healthy life. And you have no accidents. And your car goes away with all those no claim bonuses to someone else and let him claim. And that is what happened to my last car. 5 years, I did not have any claims at all. I was very happy. I was a little sad, but I was very happy because I couldn't carry it forward to my new car. And same as mediclaim, never ever have to claim, but it should always be there. Even if you are a doctor, even if you have your own hospital, you should always be there. My mother underwent a surgery which costed us 30 lakhs. Even when she took the mediclaim, maximum allowed was 5 lakhs. Accumulated bonus was 7 lakhs. And today it costed 30 lakhs. So today, you as a doctor should know the cost of the medicine. And if you want to take a mediclaim policy or a life insurance, take it as much as possible or maximum allowed for you, for your age. That is what I will advise to all my doctor friends.
Dr. Neeraj, there's a poll I have to run. Let me just...
Okay, sure.
Yeah. Can you see it on the screen?
Yes.
Yeah. So whoever's logged in can answer.
I hope everything is answered. Okay. Can you please, all of you are attending, can you see the poll and answer it? Yeah. Okay. So to fix a meeting, let me share my screen. Yeah. So let me share my screen. I have created a QR code for everyone here. So you can either scan this QR code right now and you can fix up a meeting directly with them. It will be completely free, 30 minutes, no strings attached. Or if you are seeing this on YouTube, it is there in the description, this link. You can click on the link and go to this link and fix up your meeting. So with this, I would like to thank MFA, Chanda Verma and Sneha for sparing their precious time during dinner time and coming with us for all doctors and giving us a good knowledge on life insurance. And hopefully we will cover other parts of insurance next month. Thank you, everyone. Bye.
Thank you. Thank you. Bye. Have a good evening.
Thank you.